Here are 3 simple steps you can do to prepare to buy in a shifting housing market. Because of the recent rise in interest rates, housing affordability is at its worst level in nearly 37 years, which means a lot of people have been priced out of the housing market. Maybe you can no longer afford the house that you were initially looking at, or maybe you're just sitting on the sidelines scared because of how much prices went up and you're afraid to buy and you want house prices to come back down. And you're kind of sitting on the sidelines until that happens. Well, right now, I'm going to give you 3 different things that you should focus on as a potential home buyer in a shifting housing market to set yourself up for success so that when the opportunity presents itself, you're in the best position to take advantage of the real estate market. Now, before you start to do any of the things that I'm going to mention in this video, I suggest talking to a mortgage professional. Talk to someone. Have them run your credit, have them look at your pay stubs, even if you're 6 months out, a year out from buying a house. A lot of people think that they shouldn't get pre-approved or go through the pre-qualification process until they're ready to buy. But honestly, I think that's the wrong way to approach it. By having this conversation early, by having someone look at your income, look at your credit scores, they can give you some goals to shoot for. Maybe you're already in a position to buy a home and you just didn't realize it. Maybe you thought your credit was too low, or maybe you thought your income wasn't high enough, or maybe you thought you didn't have enough money in the bank to be able to buy a home. And then you come to realize after having that conversation that you're actually in a position to buy and you can actually afford a home in the price point in which you were looking. Or maybe you're on the other side where you might need to improve your credit. You might need to get a little bit more down payment. You might need to work on some things in order to set yourself up to be in a position to purchase. And that's really what we're going to focus on today. But having that conversation with a mortgage professional early can give you some clarity and some direction and hopefully some goals to shoot for so that you're in the best position possible when it's the right time for you. Now, with that said, if you do need a referral to a lender, do me a favor, check the link below. I'm happy to refer you to somebody I know, like, and trust that will guide you in the right direction. Now, the very first thing I want to touch on today's video is working on a down payment. There's a lot of myths out there that you need a 20% down payment to buy a home, and that's simply not true. You can actually buy with as little as 3.5% down. And there's also a myth out there that you can buy with no money down, that there's people out there willing to just give you money, banks willing to give you money so that you can go buy a house with no money out of pocket. That's also more or less a myth. There are companies that will allow you to do it, but the qualifications to get those loans are very, very strict. So in most cases, you're going to need some money either for a down payment or for closing costs to be able to buy a home. And that's what we're going to focus on right now. So the very first thing you're going to do when trying to save more money, and really before you ever have that conversation with the lender, in my opinion, is setting a budget. And what I mean by that is writing down all your monthly expenses. How much you spend in groceries, how much you spend in gas, how much you spend in childcare, your gym, your cell phone bill, all of these different expenses. And take all of these things and write them out, in a spreadsheet, total the amount to see how much you're spending on a monthly basis. And from there, compare it to how much you take home per month with regards to your monthly income and see what you're comfortable spending on a mortgage payment. A lot of times when you have a conversation with a lender, the lender is going to tell you how much you qualify for. They're not going to tell you how much you can actually afford. Only you know how much you can actually afford because you know what your monthly expenses are. And by writing these expenses down, you have something in front of you that you can look at, that you can compare to, and really figure out how much you're comfortable spending per month. And that way, when you're having that conversation with a lender, you can tell them, hey, I know you approved me for a $500,000 mortgage, but I'm not comfortable with that payment. I'm only comfortable spending, say, $2,000 a month. How much home can I buy with that amount? And then the lender can go back and recalculate the numbers, and they can tell you, based on you wanting to spend that amount per month, this is how much home you should purchase. And from there, you have a better idea of purchase price of where you should be looking, at the same time knowing that you're buying a house that you can truly afford because you've done the budgeting up front. Now, at the end of the day, this doesn't necessarily help you save more money, but what you can do is once you have a budget, you can start looking at all of these things that you're spending on a monthly basis and see what you can cut out. And whatever you're cutting out, you can take that same amount of money and put it into some sort of savings account, maybe an interest-bearing account, maybe something that can make you a little bit more money. If every single day you're going to Starbucks and spending $5, $7, $10, and you know that you can do that at home and cut that expense out, you might be able to save a couple of grand a year just in that alone. And by having that additional money, it will probably put you in a better position to buy a home. But at the end of the day, unless you have somebody willing to give you a gift of funds for the down payment, you're going to have to cut your expenses, spend less money and take those savings and be able to put them somewhere and build this reserve fund so that when you're ready, you actually have some money for a down payment and those closing costs. The second thing, and probably the most important in my opinion, to try to get yourself in the best position to be able to purchase a home and really maximize how much you can afford and get the best rate and terms, is going to be working on your credit score. A lot of people out there don't understand, don't realize how important credit scores are and how much it can impact your monthly mortgage payment. And honestly, how easy it is to improve those scores. So right now, what we're going to talk about is how to improve those scores. But before I do that, I just want to give you a quick example. Today, interest rates are sitting somewhere around 6.75% for the most well-qualified buyers out there. So today, if you were able to buy a home, say an $800,000 home, and put 20% down, you're financing $640,000. At a 6.75% interest rate, your payment's going to be $4,151. Let's say you have lower credit scores, and your credit score is around 640, 650. That same mortgage payment today is going to be $4,585, and that's based off a 7.75% interest rate. So it's a full 1% worse by having much lower credit scores. The very best credit score sitting around 800 got you that 6.75, and somewhere around 650 got you a 7.75. So that's a difference of $434 a month. So by improving your credit, focusing on the things that we're going to talk about here in just a minute, you can save a considerable amount of money per month. Now, when we talk about improving credit scores, there's a lot of companies out there that will do this for you and work on things, but honestly, a lot of these things you can do yourself. There's really no magic formula. It really just takes some time, sometimes a little bit of money in order to improve them. But at the end of the day, if you focus on these things, you can drastically improve your credit scores and set yourself up in a better position to be able to buy a home at much better terms. The very first thing I want you to focus on when it comes to credit score is looking at your balances versus your limits on your card. So say you have an American Express card and the limit on that card is $10,000 and you're utilizing $8,000 of that $10,000. So you're sitting around 80% utilization on that credit card. Well, the credit bureaus out there are going to look at that as a negative. Anytime you're using more than about 50% of the balance of that limit, credit cards see that as a negative sign. They see that as that you're leveraged, and that's going to reflect in a lower credit score. What you really want to do is have your balances lower than about 30% if at all possible. You might be looking at me going, Jeb, how do I pay these down? I don't have the money to do that. I'm trying to save to buy a house, and the reason I'm using credit is because I don't have this money. Well, there's a couple of different ways to approach it. The very first thing you want to do is try to call your credit card companies and see if they're willing to raise your limit. If they're willing to raise your limit, say from 10 grand to 15 grand, now without paying down that balance at all, you're almost sitting at a 50% utilization because you still owe $8,000. Now your credit limit is $15,000. But oftentimes when you have a higher balance on your credit cards, the credit company is going to look at you and go, I'm not willing to give you more credit, therefore we're not willing to extend those. So what do you do in those circumstances? I would tell you to go back to your lender and have that conversation. Maybe you were planning on putting 20% down to buy a house and you have the money for the down payment, you're just not ready to buy at the moment for whatever reasons. Maybe you take some of that money and pay down your credit cards to help improve your score. Yeah, you're putting less money down and you might have to take on mortgage insurance, but your credit scores could improve significantly. And by having a much better credit score, you're going to get a much better rate. And in that case, you could end up with a lower monthly payment even by putting less money down by having those higher credit scores. And that's why I said it's important to talk to a lender up front, because they can go over these different scenarios with you and help put you in the best position. The second thing you can do to improve your credit scores is get added to a card of a friend, a family member, a spouse, a significant other who actually has a credit card with good credit history. They've been paying on it for, an extended period of time. They're only using a small portion of that balance, if anything at all, and you want to get added as an authorized user. And once you're added as an authorized user, that credit card is actually going to show up on your credit report. And as long as it has good standing, that should impact your credit scores in a positive way, helping you to improve those scores. Now, the next thing I want to talk about is collection accounts. If you have old collection accounts on your credit report, say they're 5, 7 years old, maybe they're medical accounts, a lot of these things don't need to be paid off. In fact, the credit scoring model is changing where some of these medical bills won't actually report on your credit report at all in the near future. But you really want to focus on things in the short term. Collections that have happened in the last couple of months, the last couple of years, because those are the ones probably impacting your score the most. Now, again, it's important to talk to a lender who understands credit and understands credit reports, because if you do have medical collections, maybe these are things that you can avoid paying and focus on the other collection accounts because of how this scoring model is going to change in the near future. And by doing that, it will likely improve your credit score. Now, if you're someone out there that doesn't have any credit, you thought, hey, Dave Ramsey's model is the best way. I won't have any credit cards at all, no car payments, nothing. I have no credit score. Well, that can impact you negatively when it goes to buy a house. In fact, there's only a handful of lenders out there that will give you a loan when you have no credit score. And with those, you have to have a significant down payment. So if you don't have credit scores at all, you really want to focus on building some credit. And you can do that by going out and getting a credit card, using the balance, paying it down, just not running it up. You really want to stay under 30%. Now, oftentimes when you don't have credit, it can be difficult to get a credit card company to actually give you a credit card. So you might go towards a secured credit card in those cases, where you're actually putting money into it, almost like a checking account, like a debit account, if you will, and spending your own money. But that will also help you build your credit. At the end of the day, focusing on your credit score is going to have a much bigger impact on your loan than anything else you do. But the third thing I want to talk about is working on your debt to income ratio. If you're someone at the moment that wants to buy a house, maybe you have good credit, maybe you have some money for a down payment, but you have a lot of debt and you're not able to qualify for the type of home you want because of the amount of debt you have. Because as you know, a lender uses your debt to income ratio, how much debt you have versus how much income you have, to be able to tell you how much loan you can get. So the less amount of debt you have, the more home you can actually qualify for. And so if you're in that position, what I would tell you to do is go back to the Dave Ramsey method, if you will, of the snowball effect. And what that is it's writing down all your credit cards with their balances and actually starting from the lowest balance first, and really focus on paying down that balance while making the minimum payments on everything else. And that will give you some momentum. And once you're able to pay off that card, you take the money that you are paying towards that card and use it on the next larger balance. And by doing this, you're knocking out the balances quicker, you're getting momentum, you're feeling good, and it makes the process seem a lot quicker. Now, there are some people out there that will tell you to focus on the highest balance first or the highest interest rate first. But again, another thing you can do is when you're having that conversation with the lender, sometimes maybe focusing on the one with the higher monthly payment first can actually help you qualify for more loan. But if you're looking to pay off debt entirely, the snowball effect is really good, but it's not the end all when it comes to paying off these debts. But you really want to focus on your DTI, paying off these debts, so that you can set yourself up for success when you're ready to buy a home. Now, another thing you can do is if you're somebody out there that has a lot of student loans, you can actually call your student loan company, the company that's financing those loans, and see if you can consolidate those loans, see if you can get an income-based repayment plan on those loans to help lower the monthly payments. A lot of people out there, a lot of home buyers, potential home buyers, don't realize how much student loans actually affect your ability to qualify. And by focusing on consolidation and income-based repayment, there's a really good chance that your monthly payments on those are going to go down significantly, and this can end up helping you qualify for more homes. And the last thing you can do is start exploring some different loan options, maybe adjustable rate loans, maybe 2-1 buy downs. Have those conversations with your lender when you're talking about the process. Take this time to understand them and get a grasp on what's out there, so that when you're ready, you're not having to learn what these programs are and whether or not you like them or believe in them. If you're taking the time now to understand the programs out there that are available to you, and again, this is a conversation you're having with your lender, that way you're getting the education, the knowledge necessary, so that when you're ready to make the decision, you're ready to go. So that should give you some things to work on as you prepare to buy. And if you found any value today, do me a favor, hit that thumbs up. Feel free to subscribe to the channel if you want to stay updated on everything real estate related. But there are a couple of things I want to talk about here that you should absolutely avoid when going through this process. And the very first one is having your credit run a bunch of different times over an extended period of time. When you're going to get a mortgage, you can have lenders run your credit multiple times within a 45-day window, and it shouldn't impact your credit score. But once you start spreading it out, maybe you're talking to somebody now, you're not talking to another lender for a couple of months, or maybe you're going out getting car loans, talking to credit card companies, whatever, and having a bunch of inquiries run on your credit report, this can negatively impact your credit score and ultimately end up hurting your ability to qualify. Another thing that we talked about earlier is maxing out credit cards. You don't want to max out credit cards. You really want to stay under 50%, under 30% if at all possible. This will help improve your credit. You don't want to have late or missed payments. You want to make sure you're making at least the minimum every single month, because otherwise that could affect your score. And lastly, you don't want to take on any new debt. You don't want to go get a new car. You don't want to go get a bunch of credit cards, take on a bunch of outstanding debt, because at the end of the day, that could end up impacting your credit score, your debt to income ratio, and your ability to qualify.